Hello everyone, welcome to the channel. If you are interested in precious metals and mining investing, please hit that subscribe button and ring the bell. That way you'll get updates immediately and support the creation of more original, value-packed content. Thank you. Don't scroll away just yet. Today we're going to talk about silver, and honestly what I have to say might make some of you a bit uncomfortable. Many people are treating this current move as just another standard bounce, thinking the price will pop a little, and then obediently retreat back to the levels on the chart that everyone is used to. But the reality is, the market never plays within your comfort zone. Right now, silver is being torn apart by two forces: relentless industrial demand on one side, and sporadically awakening investment demand on the other. When these two forces truly collide, the price action becomes baffling. If you haven't prepared mentally, looking at the current volatility will probably just make you think the market has gone mad. Today, I want to clear the air. Why, despite the massive ups and downs, I believe the silver cycle is just getting started. Then, I'll share how I look at mining stocks and how to avoid missing out by overtrading or getting scared out of your position. Finally, we'll discuss silver's real X-factor inventory, physical delivery, and what happens when a supply crunch becomes reality. Truth be told, the biggest enemy in a bull market isn't getting the direction wrong. It's getting it right but failing to hold on, ending up with nothing. Silver's recent price action feels like it's trying to prove a point. One week it's calm, the next it gets hammered, and then overnight it prints a massive green candle, forcing everyone to recalibrate their expectations. That is Silver's personality. It rewards those who can sit tight and punishes those who need every single candlestick to give them emotional comfort. If you are new here, memorize this: strong trends and violent drawdowns can coexist. A drawdown does not equal a trend reversal. Sometimes those deep pullbacks are exactly the ticket you need to stay in the game. Many people say, "I am too late." They point at the current price and sigh, "It's up so much, this must be the top." But a high price doesn't mean the cycle is late. A high price is often just the signal of a Phase 1 breakout, with Phase 2 gathering momentum. Here is how I understand the stages of a precious metals bull market. Phase 1, the skepticism phase. The market treats precious metals like a joke and mining companies as a synonym for high risk. Phase 2, the recognition phase. Institutions start taking it seriously, minor balance sheets improve, and valuations are no longer suppressed to extremes. Phase 3, the mania phase. Everyone becomes an expert, mediocre projects are hyped as miracles, and risk awareness evaporates. Judging by people's reactions, it feels like we are in Phase 3. We aren't let me slow down and define yearly cycle in a practical way that many skip over. Yearly isn't about whether the price is low, it's about participation, institutional attitude, and whether valuations fully reflect the new reality. In other words, yearly or late is a state of market behavior, not just a price level on a ruler. You can have high prices but still be early if public allocation is low, institutions are cautious, and valuations haven't expanded. Conversely, prices can be low, but if everyone is fully invested and euphoric, that might actually be late. So, next time someone says, "I am late," ask them, late compared to what? Here is a concept that completely changed my approach to mining stocks. Operating leverage. Mining costs are generally rigid in the short-term labor, energy, maintenance, transport, admin. These get paid regardless. When metal prices rise, revenue jumps almost linearly, but costs don't rise in sync or by the same magnitude. The difference becomes a rapid expansion in profit margins, which is the fundamental reason mining stocks explode higher. But leverage is a double-edged sword when prices drop. Revenue slides fast, costs stay high, margins get crushed, and the stock price gets punished mercilessly. So the core question becomes, how do we enjoy the upside leverage without being destroyed by the downside leverage? The answer is two words: quality plus discipline. Quality is picking companies that can survive the troughs. Discipline is not paying a massive premium, not going all in on one bet, and not letting short-term volatility dictate your actions. Let us talk about the decisive factor: valuation. Many people are obsessed with shouting price targets: silver to $100, gold to $6,000. That sounds exciting, but that is not a plan. Our real plan is If silver holds relatively high levels for 2 years, what will the free cash flow of a top-tier producer look like? As market confidence returns, what multiple are investors willing to pay? Even if metal prices only rise modestly, how far can the stock go just on multiple expansion? That is where the biggest potential lies. The market isn't driven by just one lever. It is driven by metal prices, production volume, cost control, balance sheet repair, and valuation multiples simultaneously. If just 2 or 3 of these turn favorable, a reasonable allocation can turn into amazing returns. I am intentionally introducing some skepticism here because being blindly bullish is easy. Staying clear-headed while bullish is hard. I often ask myself, what if the big move is over? What if the supply shortage is fully priced in? What if substitutes take over? What if recycling skyrockets? What if industrial demand slows down? These risks are real. Ignoring them makes you a gambler, not an investor. But there are strong rebuttals, even with some substitution or slower growth. The energy transition, electrification, and electronics upgrades are multi-year, even decade-long engineering projects. Military and critical infrastructure won't stop using silver just because it's expensive. And if purchasing power remains under pressure, investors won't suddenly lose interest in hard assets. So my core logic isn't silver only goes up. It is, as time passes, the probability of significantly higher average prices is high enough to warrant an allocation, provided we strictly respect the volatility. Speaking of volatility management, this is how you go from being a victim to being in control. I personally like to split my position into 3 parts. Zone core position. Hold this through everything unless the fundamental thesis breaks. 2 trading position. Trim some at obvious highs, add some during deep pullbacks. 3. Cash buffer. This prevents forced selling at the bottom. The cash buffer is more important than people think. Being forced to sell is the fastest way to turn a good idea into a realized loss. Holding cash isn't just for buying dips, it has to maintain optionality. In a precious metals bull market, a variable often overlooked is cost inflation. Many think if metal prices rise, miners win automatically. Not true. If diesel, labor, reagents, and taxes skyrocket, margins get squeezed. This is why you must choose companies with strong cost controls and stable jurisdictions. It's also why buying a basket of quality miners is usually safer than betting on a single stock. Let's talk about the mental preparation for drawdowns, because they are 100% going to happen. In a strong cycle, you will likely encounter several corrections that make you question your life choices. This is normal. This is how the market washes out over leveraged speculators and rebalances sentiment. So prepare now, expect at least 1 or 2 corrections that make you want to smash your keyboard. If you plan for it, you'll survive it. If you don't, you'll likely surrender at the exact moment you shouldn't. Here is a practical checklist for screening mining companies. 1. Liquidity. Can they survive 12 months in a bad environment too? Costs. Are they stable? Is management transparent about them? 3. Share structure. Is there a risk of constant dilution? 4. Path to production. Is it clear and achievable, or just a concept? 5. Catalysts. Is there anything in the next 6-18 months to change market perception? 6. Geopolitical risk. Could it go to 0 overnight due to politics? 7. Valuation. Does the price assume perfection, or is there a discount? This 1T make you a stock-picking genius, but it will help you avoid most landmines. Let us run a few scenarios for 2026 to help you prep. Scenario 1. Global stocks grind up. Economy is lukewarm. Liquidity is okay. Precious metals rise slowly but firmly. Miners get re-rated. This is the comfortable scenario. Every dip is a buy. Scenario 2. Stocks crash. Asset correlations spike to 1, and precious metals get dragged down briefly. The market flushes everyone out. This will be painful, but it creates the ultimate entry point for the next leg up. Scenario 3. A crisis of confidence, debt, currency, or war. In this environment, metals might gap up, physical premiums explode, and volatility moves faster than you can react. You do not want to be chasing an entry here. You need to be positioned beforehand. Side note, in a real bull market, the most frustrating, boring sideways periods often occur right before the biggest moves. If silver stops moving and everyone gets sleepy, stay alert, it's likely recharging. The biggest trap is trying to snipe the exact top. Guessing right once feels great, but long-term, It usually leads to selling too early, watching the trend continue, and then rage buying back in at a higher price. I prefer a simpler method, manage risk in tranches. When the market is euphoric and low-quality junk is rallying, trim exposure when prices look bubbly, reduce risk. This isn't fear, it is respecting the cycle. Let S bring it back to you. Our goal isn't to win an argument in the comments, but to make decisions we don't regret. Good decisions require humility, patience, and a plan. I'd like to ask, since you started investing in metals or miners, what is your biggest lesson? Buying too late, selling too early, holding the wrong stock too long, or share a success story. Real stories are powerful encouragement. Back to free cash flow, the hardcore part of mining. Mining is a real business. Dig, process, sell, pay costs, keep the cash. In a high-price environment, great companies don't just survive. They deleverage, pile up cash, expand projects, buy back shares, and pay dividends. That is how a mining stock transforms from a high-risk speculation into a compounding machine. So, I always filter by 3 dimensions: balance sheet health, margin sustainability, and project quality. I care about the potential 24 years from now, not next week's share price. If those 3 align, you are investing, not gambling. Yes, silver is volatile. No one can deny that. Silver isn't the kind of partner that lets you sleep soundly. It's more like a thrilling romance. It can change your life, or it can break your heart. Pretending it has only upside and no risk is why many get taught a lesson by the market. Ask yourself, do you want to be right on every candlestick, or right on the cycle? If you want to be right on every candle, you overtrade and likely buy high and sell low. If you want to be right on the cycle, you accept the messy path, plan your zones, and ignore the short-term noise. Regarding mining stocks, this is where people either make a fortune or double their stress. Miners have multiple layers of leverage, to metal prices, to operational efficiency, to management execution, and to market sentiment. That's why in a tailwind, they outperform the metal by multiples. In a headwind, they fall much harder. The mistake is treating them like blue-chip stocks. They aren't. They are highly cyclical assets. Don't avoid them, just respect their nature. Another mistake: buying miners like lottery tickets. Buying a ticker because you saw a chart, but knowing nothing about the company when it drops. You panic because you have no anchor. You sell at the bottom and claim the market is rigged. If you don't want to waste this bull market, have a thesis. You buy a company because it has a path to cash flow, a strong balance sheet, and a stable jurisdiction. That is the real story. And let's talk time horizon. If you buy a developer, don't expect it to turn into a cash cow in 1 quarter. Mine construction and permitting take time. I layer my portfolio, own metal proxies, FAFs, 2, producers, real cash flow, manageable debt, 3, mid-tiers, growth projects, 4 developers, near-term catalysts, 5 explorers, high risk. This way, even if one subsector cools off, the portfolio keeps you in the game. Another psychological trap, staring at the account balance. You bought at 5, it goes to 7. You feel like a genius. It drops to 6. Fundamentally, nothing changed, only your emotions did. If you can't handle normal pullbacks, you won't hold for the wealth-creating phase. I set 2 exit lines. The logic line, what invalidates my thesis. The emotion line, what rule stops me from doing something stupid when I panic. Finally, let's talk about silver's X factor, inventory and physical delivery. Some say silver is overflowing, others say we are running out. The truth is in the middle. Silver is embedded in the modern economy: electronics, solar, EVs, medical. This demand is rigid. As industrial activity stays strong, available inventory gets drained. Add investment demand, which is like a wave, sudden and violent. It doesn't take much investment money to push the physical market to a breaking point. If the system feels pressure, we might see price spikes to ration demand, thrifting by users, or institutions bypassing retail to secure metal. I don't make singular predictions, but I don't ignore stress signals. Once big users struggle to get metal, market psychology changes faster than any model can predict. If a shortage gets real, don't expect dramatic movie scenes like confiscation immediately. Expect lower friction sourcing, pressure on holders, recycling incentives, and strategic reserves. But to achieve this, the price may move in violently counterintuitive ways. For those stacking physical silver, physical is insurance. It's an option outside the system. But it doesn't compound. A strategy to consider. Use mining stock profits during the cycle to convert paper gains into more physical ounces. That is how you turn volatility into accumulation. Final summary: silver is extreme, but structural opportunities outweigh short-term noise. Miners are leverage, they amplify gains and mistakes. Winning isn't about predicting every step. It is about a plan that survives volatility and aligns with the macro cycle. Leave a suspenseful thought. There is a scenario that will shock everyone who says, "I am late." That is when physical tightness goes from a slow grind to a critical point where buyers stop asking, "How much?" and start asking, "Do you have any?" In that moment, premiums spike, delivery delays hit, and those waiting for confirmation will find that confirmation is incredibly expensive. So ask yourself, if silver gaps up tomorrow while your position is light, do you chase or watch? Your answer determines what you should do today. If you found value in this, please subscribe, like, and comment. I am still here, so I know you re-listening. See you in the next one. Disclaimer: this content is for educational and entertainment purposes only, and reflects personal opinions. It does not constitute investment advice. Precious metals and mining stocks are highly volatile. Please do your own research and consult a professional financial advisor before making decisions. Invest at your own risk.